You've probably heard that there's a stock market bubble in the United States because of the excitement about artificial intelligence. Well, we've got a bubble of our own. It's called Commonwealth Bank. Bubbles are where valuations depart from normal reality, with investors believing that this time is different. And the trouble is you can't be sure it's a bubble till it bursts. So here's the Commonwealth Bank share price versus the All Ordinaries Index since 1991, when the bank was privatised. That last spurt, up 70% since October 2023, has been devastating for the investors who thought it was too expensive 16 months ago and refused to own it. Has it been a bubble? Well, I don't know, but it sure looks like it. And now, maybe it's over. Last week, the share price fell 8%. It's too early to say the bubble has burst, but cracks are appearing. Now, the key way to value a bank is called the price-to-book ratio. It tells you how much you're paying for each dollar of a bank's assets, that is, its loans. With CBA, you're paying $3.70 for a dollar of loans, way more than its own average and the sort of level that's usually followed by a big correction in its price. It's about double what you pay for the loans of the other big banks. And that's despite the fact that CBA's dominant market share has been drifting lower. In fact, investors are paying more for CBA's loans than any other major bank in the world by far. In fact, it's probably the most expensive bank in the history of the developed world. Well, bubble or not, this is the most important fact about the Australian share market at the moment. If it crashes, the shock will be felt throughout the Australian investment, superannuation and business scene. If it doesn't, a few investment rules will have to be rewritten.